Hello all and welcome to the second session of our webinar series that we have teamed up with Smith & Williamson's excellent team to talk through. Today we're on part 2 of how to optimize your cash flow through the COVID crisis. And we're going to run, just whilst everyone's filing into the webinar room, we're going to run on a very similar format to last time. So we've got, we want to make this as interactive as possible. So we've got a Q&A box within your webinar control panel. So do feel free. We'd encourage you all to add questions as we go. If possible, we'll take them as we go, but if not, we're going to leave plenty of time at the end for a Q&A before we wrap up. So just to run through, I want to link through very quickly to our session last time when we were talking about cash flow issues for cash-strapped companies. We discussed solvency issues and set the scene there. We then talked about how to reduce cash flow to save costs and also how to optimize funding with government funds and other grants that are currently available. And then finally, we closed with a bit of a session on fundraising itself and the challenges that you need to be dealing with and the timing constraints, what you need to think about when endeavoring to raise funds. So leading on from that, we've got some great content for you today and a team of panelists that I'd like to introduce. We've got Mark Benker again, who is a partner in the transaction services team at Smith & Williamson. We've got Alistair Shaw, who's a partner in the business tax services team also at Smith & Williamson. We have Michelle Sheen, who is one of my partners at Field Fisher in the financial markets and products team, who I work with on restructuring transactions and generally call on to help whenever clients are getting a bit close to insolvency or in a distressed situation. And we're very pleased to be joined today by Adrian Hextall, who's a director in the tech team at Smith & Williamson. And what we wanted to do by teaming up with them was to pool our expertise across the legal and financial side so that we could offer much more practical advice and just make this a bit interactive and fun. So today, what we're going to cover is how the quality of your financial data can be improved and the importance of doing that right now. To talk about financial information and the importance of transparency and being transparent with all of your stakeholders, and also how to prioritize your stakeholders into order when it comes to being distressed. We wanted to talk about good governance and the importance of improving governance wherever possible right now, because that establishes a good trust with your shareholders. And then just to hammer home really how long it takes to raise funds, and now more than ever. So we'll talk about that at the end. As I say, please feel free to add questions as we go. Mark, Alistair, am I handing over to you at this point to talk about the quality of financial data?
Yes, it's me to kick off. Mark Benker here. Good afternoon, everybody. It's just worth reflecting, I think, when you're running a business, raising money, executing M&A, it's always a combination of sort of analog and digital, i.e. it's relationships, and managing those, and it's hard data as well. I think what we're finding during this lockdown period, that because relationships have been impacted, then it sort of brings into focus the importance of hard data, and people are using that. There's always been this sort of general shift to improve data, much sort of big data and what you can do with it. But I think this sort of shutdown is accelerating that shift. So it's really important when at the moment when you need to make some swift decisions, having that data really available to you at the right time to make those speedy decisions. We've seen a lot of crisis management going on at the moment, and having good real-time data is absolutely critical. And as we come out of the lockdown, we'll want to see what those leading indicators look like as businesses try and grow out of it. And also, business models are changing somewhat depending on which sector you're in, and actually having a flexible financial reporting and flexible data to kind of show what's now relevant to your new business is also critically important. But certainly in M&A, advanced analytics on financial data is increasing all the time, and I see that a big part of businesses running themselves day to day in raising money and in executing M&A. So I'm going to hand over to Adrian now, who's going to talk a bit more about that.
Thank you very much. Next slide, please, Tim. Oh, that was the next slide. Sorry. Yeah, back one, if you would, please. I suppose the key areas that we look at in this particular space and how the quality of financial data can be improved is around the three items that we've got mentioned there at the top of the page: data governance, the way data flows throughout your organization, multiple systems often having to talk to each other and not always being able to talk particularly accurately to each other. If we can combine all of those, an understanding of how our data should flow throughout an organization, how we can ensure that we do keep it as accurate as possible, and maintaining particular protocols and procedures in place so that that information can flow regularly, naturally, and also at a time when it doesn't impact whatever we're trying to do on a day-to-day basis as well. I mean, historically, when we're thinking about data, people will naturally gravitate towards the thought of spreadsheets, pivot tables, lookup tables, source information that they've pulled together over a multiple periods, lots of different phases throughout time where they've held information and want to use it as a reference point. That naturally increases the amount of manual manipulation that we have in place within an organization. The person that pulled it all together is probably well placed to understand how the information has been generated, where the information has come from, how it's all been stitched together, and ultimately then what results are being displayed. But if you take that one pivotal person out of the equation, is it then clear to the rest of us where the results come from? Possibly not. And it's how we look at that and how we improve that level of data flow and information gathering in the future. Because apart from anything else, we're of course coming under increasing scrutiny from regulators. Our investors also want to understand the data to better understand what they are looking at in front of them. It's not just a pretty chart, it's not just a pretty graph, it's the underlying information that they need that level of accuracy from.
And actually, Adrian, it's probably worth mentioning there that part of the challenge for shareholders is that they are also, if they're financial institutions, they are also coming under pressure from their investors to show greater transparency in their individual portfolio companies. So it's twofold there.
Absolutely, and that transparency piece, I think, is where the world is definitely going to. A week doesn't go by at the moment without another digital reporting requirement of some sort, be it a demand upon your own organization so that you have better insight into your own portfolio and holdings, or it could be something that a local territory regulator has put in place as well. That data flow and accuracy piece comes, as you might imagine, through an increased use of different software platforms. Very, very commonly these days, data is now stored as what we would classify as a project view. Functions similar to Excel, formula, the concept of joining information together, looking it up from somewhere else, and pulling that together in real time allow us to be more efficient in those particular spaces. But the key these days is very much around routine. If something can be done in such a way that it can be automated, it can repeat itself time after time, those routines can be rerun time and again, and also at that point, and we'll come on to later potentially, is when we're least expected to. So it's on demand, it's not within a certain time frame. And the ability to run that information, consolidate, present it, means that we've got the opportunity and ability now to examine data more accurately. And as you can see on the right-hand side of the screen there, the clear visuals is one of the key components. If we can see at a glance something that means something to us, something that stands out, something that needs our attention drawn to it, visualization these days is one of the key components. It's a simple thing, it's very, very common. Even if you look at your bank accounts, your credit cards online these days, you'll see spending patterns, management information, intelligence that's presented to you about your patterns You didn't ask for it, but it's there, it means something, and it's easy to digest and makes you think, I better understand that now.
And it helps avoid data blindness.
It does indeed, yes. We only had to go back perhaps 5-10 years at the most, and if we were doing data analysis work, we'd be presented with 2 million plus records. We'd think we'd done a fantastic job of narrowing that 2 million down to 2,000 to present back to somebody. But realistically, you can get data blind very, very quickly from having 2,000 lines of data presented back to you. You never see what you're supposed to. Much better. The final piece just on this that I want to really dip into is that visualization component. Good data governance means that you can look at this from any angle imaginable. Picture a cube, if you would. Are you going into the information you're interested in from the top, the bottom, the side? You've got multiple ways into the data to then route around and then ultimately come out at a different place from where you started. And if we can just click on the go button for the video on this, just to give you an example of what we're looking at here. What you're seeing on screen, multiple chart options.
Disappeared.
No, don't worry. I can talk to this one.
You just talk through it. That'd be great.
That's not a problem. You can see in the top right-hand corner, and I suppose this is the easiest way to explain it, to visualize it in your mind. Picture a satellite orbiting the Earth. That satellite is looking down on the largest set of information and data available to it possible. It's looking at everything at various points around the world, at various points in time. To be able to drill down to a continent, a country, a region, a town, and then look at the individual organizations within that town, as that map is able to do on the right-hand side, you're able to pinpoint who you're dealing with, when you were dealing with them, the information you can glean from them about particular transactions. That level of information is then presented on all the additional bar charts that you see there, and then from there, you're able to drill down into individual transactions, individual scenarios. You're able to pull from it trends, other information that will help you make informed decisions about the sort of investments, the sort of returns, the sort of information that you absolutely need to be able to take control over a particular transaction. All of that is available within a data set. And if you think about it with that satellite view as your starting point, doesn't matter where you are, you can get into it, you can drill down, you can get to the detail, you can get the insight that potentially you were previously missing as well. Thank you, Tim.
Adrian, just a quick question from me. So what are the main drivers from the clients that you're working with, probably more recently, around improving the quality of their data? What are the main drivers for those coming to you and seeking your assistance?
It's a mixture. It's accuracy over interpretation. So a lot of the clients that I'm working with at the moment, for example, may well be looking at regulatory reporting requirements. They could be looking at better understanding what's going on within their organization. It could be simply a case of wanting to do the correct statutory filing and the correct information on a tax return. Ultimately, everything goes from summarization and an understanding of what's making up the numbers on a particular document or a particular transaction to what then sits behind it. And typically our clients that we are dealing with have got multiple legacy systems in place. They're not all on the same accounting or finance platform. And as a result of that, trying to consolidate that information when it's all in different formats, very, very difficult. And especially where we're looking at key drivers like transactions that have taken place cross-border, for example, investments that have taken place across border as well, where they need to be picked up, identified and reported for the regulatory requirements. We're seeing an increased need for that because it is pinpoint level transactional detail that we need. And by putting this in place, we're able to run all of that information out of hours. We're able to do it in such a way that it's delivered and ready for the recipients the following day when they come back to work. And that's one of the biggest things we're finding, especially with remote working at the moment, that if people don't have the ability or the bandwidth to do it during a standard working day anymore, you can automate all of that out of hours, pick it up when you log back on the following morning.
That's great. Thank you, Adrian. Shall I just continue scrolling through?
It should, there you go, take you to the next slide.
Excellent. So I guess just to bring the financial data analysis side of the equation back to my particular perspective on the legal side, and the importance of good governance and also regularity of financial reporting, I think it's important to talk about what your board structure looks like. Many growth companies that are going through the funding rounds and are almost perpetually in some form of fundraising mode that we work with will quite often have one or two non-executive directors on the board they've been encouraged to bring to the board rather than reaching out to hire them themselves. That's not always the case, but once they've got financial investors, they'll often be encouraged to take on board one or two NEDs, as well as being joined by board observers, investor directors, and the board quickly starts to grow. But one thing that we see from the sidelines, often working through our company's secretarial avenue, is that companies don't always optimize the use of those directors. They're sort of seen as a necessary evil and something they have to pay for on a regular basis, but they don't necessarily make the most of them. So what I would suggest is that right now you've got those people within your network and within your board. Make sure that they are working to earn their living. Can they open doors to investment? And do they have restructuring or distressed company experience? Certainly, we're seeing now amongst CFOs and financial controllers, those that have historical experience of other economic downturns are finding it far easier to deal with the current requirements for additional reporting. We know that clients are being asked to produce far more financial data for their various stakeholders. There's a lot more scrutiny and a lot more regularity of scrutiny, I think. With board observers, you may find that those board observers have rarely shown any interest in the past. They will come along to the formal board meetings where we as the lawyers have circulated board minutes and asked people to come along to make a particular decision. But our experience is that it's relatively rare that they'll turn up on the allotted number of board meetings that companies agree to have in their shareholders agreement. We normally see them saying, yes, we agree, we undertake to hold 4, 6, 8 board meetings per year. But these days things move so quickly, particularly for tech companies, that a lot of decision making happens behind the scenes and over email, and it's rare that those decisions are actually taken by the full board. So now is the time to keep those board observers involved. What we would suggest is that instead of looking to hold board meetings every other month or once a quarter, if that's what they're doing, we would be encouraging companies that are concerned about cash flow to start reporting, to start holding formal board meetings at least every other month, perhaps monthly, and in some cases even weekly if you're starting to engage with insolvency practitioners or are concerned that you might be on, tipping the balance in the wrong direction. Engaging everyone on your board in those meetings will make sure that your shareholders have a degree of confidence that the governance is being tightly controlled. And that, of course, makes them more inclined to introduce you to new investors, or more importantly, to actually cough up further investment themselves, which may be needed to take you through the next 3 to 6 months. The other thing I would suggest is make sure that if you are struggling with the financial data yourselves internally, think about inviting your reporting accountants along to a pre-board meeting. We often find that some of the most useful meetings that we hold as lawyers are the ones where we're invited to join a board for a pre-board meeting to run through the agenda from a legal perspective, set the background, particularly where boards only meet periodically. There's often at the moment going to be a particular agenda for them needing to meet, and it can just take the ice off it if there's a third party in the room who can lead them through the agenda, talk about some of the concerns that have been raised behind the scenes. And I don't know about you guys, we often get targeted by the shareholders, the observer directors, as well as different board members asking for different bits of information and documentation. You always know when a company is starting to feel a little bit stressed when people are saying, can you send us the CEO's service contract to have a look at, for example. I was just wondering, do you find this sort of thing on the financial side as well? You start asking those telltale questions? Mark or Alistair? Do you get dragged into pre-board meetings periodically?
I mean, I think our challenge is more the other way around. Actually, we don't get invited early enough. We find probably lawyers get in there first before we do. I mentioned it last time actually that when distressed or stressed situations, we're often a bit late to the table. And actually, had we kind of had some conversation earlier, it would have been a different case. So
yeah, well, that's interesting.
In the same way, it'd be really helpful to be there, but actually, largely we're not. But it's difficult to get yourselves in there. I think I can see it potentially has some way. Some people might think it's a cause for alarm, but actually, it should be good governance and getting the right people in.
Yeah, look, sorry, carry on, Mark.
Sorry, so I was going to say, I'd echo Mark's comments. I think it depends on the strength of the relationship as well. Where we have really strong relationships with boards, they feel they can pick up the phone just and ask those questions. I think sometimes they wrongly think, well, the minute they pick the phone up, it's going to cost money. And at this point in time, they don't need those additional costs. But again, like any good advisor, happy to invest, happy to help where we can. But absolutely agree, Mark, we don't see it probably early enough, and that's where we could probably add more value.
Look, I think right now we're all keen to support our clients as best we can, and I never have a problem being asked along, even 5 or 10 minutes before a board meeting. If I'm free, I will happily join a meeting and help talk through some of the concerns. And it certainly our experience is that we can avoid crises from going too far, where particularly people are starting to get concerned about particular board members. It can just take the heat out of some of the situation. If professional advisors are in the room, you can always feel free to kick us out before the actual board meeting itself. But I think that's something that's worth considering. And the other thing, of course, when you're contemplating increasing the regularity of your board meetings, make sure that you circulate a proper agenda before the meeting. Get your company secretary to prepare draft minutes. As a record of those board decisions is going to need to be shared as part of any due diligence in a fundraising, and it shows a professional attitude to governance, which most financial investors gain a warm glow of comfort from. So companies that need to raise further funds, as we've said time and time again, almost always leave it later than they should before informing their existing shareholders that there might be a problem. And the challenge with that is, of course, quite often you're going to need to obtain consent from your existing shareholders before you go out and raise new funds in any event. And one of the quickest forms of raising funds is from your existing shareholders. So they are going to have to go through their decision-making process. If they're a VC, it's quite possible that they're going to be later in their life cycle of the fund than they were when they originally invested. And normally during the last couple of years of a VC fund, that particular fund is just looking at exiting. So it's not planning to continue reinvesting in portfolio companies. And it may be that they need to tap into another fund that they also co-manage. So again, that's the sort of thing that takes time behind the scenes. And if you can think of it from the point of view of your investors and try and give them as much notice and as much information as possible, they are going to be very thankful for that and hopefully reward you by being much more trusting and also quicker to give you the funding that you might need at this point.
And so Tim, what are you seeing on that? Because I guess from the clients I've got who are probably struggling a bit at the minute, that they have largely gone to existing shareholders and they've been supported well. Is that what you're seeing on your client base?
Yeah, look, I think most investors have been. Most investors recognise right now that what we are going through is completely unusual and challenging times. And you know, if they have made an investment in a good company, they will want to see it coming out the other side and thriving. And they know that that bad decisions get taken once companies are in a state of distress. You start firefighting rather than being strategic. The sales team get pulled off making good sales because it might be that they have to invest a little bit of upfront money or take on board some new technology to be able to make a particular sale. And quite often you just need cash flow to get you through that. But as a result of it, you're going to be able to make some far larger sales and come out the other side stronger. So I think the reality is you'll be asked to hit milestones. You're going to be that the funding that's put in place is not necessarily going to be the cheapest, but it's quite easy to put in place a convertible loan note with minimal fuss, and that can happen very quickly. So look, keep them on board, and I think most people will be quite supportive. I showed this slide last time, so I'm not going to dwell on it, but just wanted to re-emphasize that the life cycle of a fundraising tends to be towards the 6 months rather than the 3 months. And I know that many clients say that that's too long, but our experience is that equity fundraising at least takes far longer. At the moment, as I just said, convertible loan notes can be put in quite quickly, and you can worry about some of the valuation methodologies. You can postpone the conversation about dilution of equity until the next fundraising if you put in place a convertible. And just to re-add that now might be a good time to think about getting a strategic investor on board if you haven't already got one. If you've only gone to financial investors previously, you might find that working with a larger strategic can widen your distribution capability. So it's not all doom and gloom. That there may be an opportunity right now to get on board a new type of investor and to change your shareholder dynamic. Though my instinct is sticking with what you've got and working hard with them is possibly the right way to go right now. Yeah, just to add from this slide, financial transparency, creating trust is so important. And then, you know, trying to leverage the networks of your shareholders. Financial investors always promise to open the doors to other investment opportunities. Now's the time to call for that assistance. And of course, on the next slide, I wanted to bring in Michelle Sheen, who hasn't had a chance to speak yet. Michelle, as you know, when I place that call to you and say, Michelle, I'm just wondering if you could take a look at something for a client of ours, you know that the likelihood is that I've had a call with a bit of a squeaky voice from someone saying that they're wondering whether they're solvent and they're struggling cash flow wise. What are the sort of things that you start thinking about in terms of priority at the point at which I place that call?
Well, it's funny because I think one of the themes of this call, and certainly the last session, is that very often companies don't take professional advice soon enough. So you do sort of dread that phone call because it's very rarely do you want to come in and just have a quick chat because we're in a bit of a stress situation. It's usually we're really distressed and we're technically insolvent, but we're okay, which always worries me slightly. So the things that you will start thinking about, especially if you're talking to a shareholder or a creditor, a lender creditor of the company, is if this company does go into an insolvency process, where does that creditor or shareholder sit in the priority of payments? So this applies really on an administration and a liquidation. Obviously, the company has to go into a process for this to apply, but this is something I find it's very, very basic. And a lot of people forget this when you're in the throes of dealing with a good company and everything's happy and you're just setting out. People don't always think about where they sit if things go wrong. That's human nature. So what I wanted to do is just take you through the order of priority for creditors on an insolvency, just to see where people sit if things do go wrong. So obviously you can see from this, this is just going to be a quick canter through. It's a little bit more complicated than this, but this is just a very brief run through. You can see from this slide basically that security is king. If you're a secured creditor, you will generally get paid prior to everyone else out of proceeds of sale. So the realisations of a fixed charge security will be paid to fixed charge secured creditors. For example, a fixed charge security is over a property, some real estate, something fixed and tangible. It's usually something where the borrower has to ask consent of the charged credit, the chargee, to sell that secured asset. That's how you know it's a fixed charge asset. Once the secured creditor has been paid off, any surplus flows through the waterfall as I've set out on the slide. So the second people to get paid out in an admin or liquidation are the preferential creditors, which until the new law comes into force, at the moment only constitutes employees for a portion of unpaid wages. The third people to get paid are the floating charge secured creditors. Now, very often when you have a company, the company will grant a debenture rather than individual charges. That debenture will normally have fixed charges in it and floating charges in it. So fixed charges over real estate, more tangible assets like intellectual property, and a floating charge over all the rest of the assets of the company. So you generally get a floating charge over things like stock, assets which are just constantly changing their nature. The problem with a floating charge is that when you have realisations of these assets, you can't just pay this money direct to the floating charge secured creditor. This money is to be used for various other things on an administration or liquidation. So first of all, the administrator or liquidator's fees are paid out of those proceeds. We've got Smith & Williamson on the call, so obviously their fees aren't extortionate when they go in as administrator or liquidator, so you can use them to be your administrator or liquidator. Very good value, obviously. The expenses of the nice plug for our clients. The expenses of the insolvency process will also be paid out of those realisations. Disbursements that the administrator or liquidator has had to incur, including legal fees, again, ours are incredibly reasonable. And then the last thing that gets deducted from the floating charge realisations is what's called the prescribed part. This is basically just a pot of money that's deducted from floating charge realisations and set aside for unsecured creditors. It's usually up to the amount of £600,000. That's the cap. It decreases on a sliding scale depending on the amount of floating charge realisations. Any excess, any surplus from any floating charge realisations will then be paid to the floating charge secured creditor. Next person on the list, almost at the bottom of the rankings, are the unsecured creditors. They're just usually your trade creditors, HMRC, any unsecured loans. And then, of course, you have your shareholders. The shareholders get any surplus after everyone else has been repaid. This is extremely rare, and in 30 years of practicing, I've only come across this once. So I think if you're a shareholder, don't hold out any hope at all that you're going to get any repayment on an insolvency. So if we move to the next couple of slides. Sorry, Tim, did you?
No, that's okay. So the reason I wanted to ask you to explain, talk through this list of priorities is because for most companies, their day-to-day interaction with stakeholders is actually shareholders. It's the shareholders that shout the loudest. It's the shareholders that, because of the nature of their investment, are always asking for extra data, extra financial information. Are you meeting your metrics? Are you hitting your KPIs? And I think many boards get into the habit of being quite transparent with their shareholders, but actually one of the interesting things about coming into that point of potential insolvency is that you don't need to show so much priority towards your shareholders, and you can start thinking wider.
Yes, absolutely. As we discussed on the last training session, if you start moving into what we always term as the twilight zone, a distress situation, the director's duties shift from being owed to the shareholders, which are the fiduciary duties as set out in the Companies Act, to being owed to the creditors of the company. Once that happens, the shareholders sort of get put on the back burner, because as you can see from the last list, they get paid in the last in the order of priority, and as I've just said, it's very rare that they would ever get paid. So what directors are going to do with their time and focus is to use that on dealing with the other stakeholders in the business, the ones higher up the waterfall in the previous slide. That's the way that it would normally work. So the directors are going to start talking to the bank, probably HMRC, anyone who can issue a winding up petition, anyone who's debt suppressing, usually leaving the shareholders a bit out on a limb. It's probably quite a red flag for shareholders that if they've always had a lot of information forthcoming from the company before, and the company's been a bit stressed or moving into distress, and they stop getting so much information, it may be, not always, but sometimes, that the directors are actually changing their focus on dealing with the other stakeholders in the company, the ones who have more to complain about should things go wrong. So, I mean, this leads on to whether, if the company is in a stressed or a distressed situation and the shareholders are asked for more money, do you put in equity or do you put in debt? So there's advantages and disadvantages of both. So equity is advantageous because it doesn't show up as a liability on the balance sheet of the borrower. That's great. It means that you're not going to have too much problem with your other lenders, any institutional lenders. They're going to be quite spooked by taking on extra loans, even if they're unsecured. It does mean that you will still have an element of control over the business because you've increased your equity stake. A big point for me, and this is something that comes up a lot when we are doing restructurings, is that if you invest equity, there's no antecedent transaction problems. Now, antecedent transactions are things like transactions at an undervalue and preferences, basically transactions that a company can enter into in a time period running up to the administration or the liquidation, whereby that transaction will be overturned. It will all be unravelled, basically, and the parties will be put back, if they can, in the position they were in immediately before the transaction. You don't have to think about that kind of thing if you're investing equity. The disadvantage, obviously, as we've just seen, if you invest equity, is that you are repaid last in the creditor waterfall. So on that basis, should you invest debt rather than equity? Obviously, that affects the balance sheet position of the borrower. Will it make you, in a distressed situation, actually balance sheet insolvent? That has ramifications, for example, on wrongful trading for directors, where they can be personally liable for debts of the company, whereby wrongful trading only applies under the Insolvency Act where the company is actually balance sheet insolvent. So it's worth considering. You will also have potential antecedent transaction problems, because if you are taking security, that could in fact be a transaction at an undervalue or a preference. I'm not going to go through a lot of these antecedent transactions because you could do a whole training session on these just on their own. But it's just something that you've got to be aware of. Obviously, as well, taking on more debt, especially if you want this to be secured, as we've seen, an unsecured debt will be paid almost last in the priority of payment. A secured debt is elevated. If you want to take on a secured debt and the borrower company already has institutional lenders, you will more than likely have to speak to the institutional lender to get consent to take more security. That in itself can cause you a problem, as very often that takes a few weeks to go through credit committee, and it can delay the process of getting that investment into the company. But as we've seen, the quid pro quo for that is that it elevates your repayment. The one thing to note before I finish is that if you have pre-existing secured creditors, your new security will rank behind them. So it still elevates your repayment possibilities under the waterfall, but it does mean that someone else gets paid before you. So I'll hand back to Alistair and Mark.
Thank you very much. So we've got about 5 minutes left or so.
Yep.
So I'll just hand over to...
I quickly wanted to whiz through on a positive note. So where businesses are raising money or exiting in good, better times, really, and just talk about kind of getting prepared at the right time, and just to explain why and some of the things to think about. So these are a few comments that I've had during my deals from business owners about post the transaction, what their experience was, and which is why
I thought we were on top of financials.
Yeah, which is why I always ask the CFO what experience they've had at the start of a process, just to kind of manage expectations, because it is much more involved than they always think, and just to sort of manage that. It is painful in some ways, but the more philosophical of sort of CFOs, management teams, do actually see the benefits and some learnings of going through this, and actually adopt some of the things going forward. So it is helpful, although sometimes often very painful. And then also from investors, really, kind of what's their view on things. So it is important. It gives an impression of you all the way through. If you're taking sort of 2 or 3 weeks to come up with a piece of data you should have to your hand, it doesn't bode well. So that's important to know. I mean, over the end of the day, when a VC PE house sort of goes into a business, it's already thinking about the exit, and certainly 2 to 3 years out, it's planning and preparing itself, making sure it's got processes, the right financial data in place to do that smoothly. Just moving on to the next slide, Tim, if you could. So the message clearly is prepare early. The intensity is quite significant. I think during the heat of the battle, there are 3 things that are going on at the time. You're pitching and selling the business, you're running the process and the diligence that goes with that, and you're having to sort of run the business day to day. I typically see that management teams could manage 2 of those, but not all 3. So to the extent you can get yourself organized, that allows you to do the important things, which is pitching and selling the business and keeping it running along as smoothly as possible. I mean, Alistair and I were looking at a travel business end of last year. It was in the worst state I've ever seen any business in my life, actually, in terms of financial sort of governance, preparedness, data. Just there were no monthly management accounts, and this is a business of sort of 25 million revenue, quite extraordinary. The deal actually didn't fall over because of that. It fell over because management had to spend so much time pulling together the information it should have had. It lost sight of the business, and ultimately those sort of leading indicators of new bookings and stuff gradually flattened, fell off, and that's ultimately what caused the deal to be pulled. So that's the sort of the message, really. There's other things to think about, which I put down there, but I think it's probably worth moving quickly on to tax, and Alistair with a few comments around that, what you might be thinking about.
Absolutely.
Yeah, just very quickly, Ben. So 2 main themes here. The first of which, are you structure ready for investment or exit? So one key consideration is thinking about your existing investors and shareholders. So, with what you're planning to do to your structure, the investment, the sale, how's that going to impact the EIS investors? How's it going to impact the EMI option holders? So often we see this too late, where we get involved on a transaction after something's happened and they've lost their relief, and it's very costly to the existing shareholders in the business. The other point we see a lot of is your group structured appropriately. So is it in a combined group? Does it need to be? Is the IP separated? Is it in that group? Or do you want to separate part of that business before you move forward and sell? So again, we do a lot on that before the investment or the exit. And then the other point, this is really important, and Mark mentioned the example we had recently with quite a poor example really, is are you ready for the tax due diligence, or are you going to lose value on that? So have your tax files ready, have everything in order, and identify any of these issues which might come up and try and resolve them if you can before you're interrogated by the buyer side advisors to doing the DD. A lot of value can be lost there, or transactions can fall over.
Much better to have identified the skeletons in the closet before they are found by the other side, because you can then work out how to present them.
Well, and also that, and otherwise, what do we do with advisors? We always paint the worst case scenario plus interest plus penalties. You know, so if you can try and resolve beforehand, always the best way.
Absolutely. Thank you very much for that. Well, look, we got maybe 1 minute or 2 minutes left for any questions, but I've been keeping an eye and we haven't had any questions as we go. Maybe I'll just throw out one of my own whilst people are thinking. What is the sort of the number one item on your list for distressed businesses right now? What should they be thinking of top of their agenda from a financial and then from a legal perspective?
I mean, I think financial.
Go on.
Go on then. I think we mentioned it in the last seminar. I think it's scenario planning, and talking to your stakeholders, talking to your lenders, and keeping an open dialogue. I mean, I think we talk about, a lot of people have talked about relationships as we went into COVID, about having what an advantage it is to have good banking relationships, and that facilitates some good conversations and a supportive attitude from the lenders. And that's definitely been borne out. I mean, ultimately the numbers have got to add up, but it does put you in a much better place.
Yeah, and flexibility of business plan at the moment. I think, you know, we are seeing there are some opportunities as we move to a more online existence. Digital transformation does seem to be accelerating more than ever before. So I think those companies that had started that process can look at making the most of it now, although the challenge with that, of course, is that it can require some additional upfront investment. But that's where, again, talking to your shareholders and having that good relationship with them is more likely to unlock some further investment. Well, listen, in the absence of any detailed questions at this point, people should feel free to continue sending us questions afterwards. We've got everyone's contact details apart from Adrian, who kindly joined us at relatively short notice. Adrian, we'll add your details to the panelist contact slide before we circulate this with the recording afterwards. We will be sharing recordings for both the first and second session in due course. We'll send everyone links that has dialed in, and feel free to share those, and also feel free to follow up with either of us, either the Smith & Williamson team or the Field Fisher team. We'd be very happy to work together to help in any way we can. And a very, very big thank you to my panelists, Mark, Alistair, Michelle and Adrian. Thank you all very much.
Thank you.
Thank you, Tim. Thank you, everybody.